How are you guys doing? Thank y'all for having us again. I guess it's been, I don't know how many years have we been doing this now? 5? 4 or 5? Yeah, something like that. It always surprises me how many people show up to hear about taxes. Maybe it's because it's the first meeting of the year. Maybe you guys just really enjoy hurting yourself. I don't know, listening to all this, but we'll try to keep it informative. We'll try to go quick through a lot of it. What I will say this year, there are quite a bit of changes because, as you guys have probably heard, there was some legislation passed, the one big, beautiful bill that had a lot of things in it. Really what it did is it extended a lot of things, or it, there's some changes here and there, but it's not as big as legislation changes that we've seen in the past. But because of that, there's a lot of information to go through, so we included a lot of slides in here, more than we normally do. And you'll probably notice as we go through, some of them we'll go through kind of quick, but we're going to try to focus on the ones that we think will apply to you guys the most as we go through. I'm going to go through and do the business updates as we do it, and then Lynn, halfway through, is going to take over and kind of go through more of the individual changes. And as we go through, if you guys have any questions or anything, that's fine. Just, you can raise your hand, we'll answer your questions as we go. I think we should have time to do it that way. So let's go ahead and let's do a bonus appreciation. So this is one of the biggest things, probably the biggest thing for the business updates is bonus appreciation. What bonus appreciation does is it allows you to kind of take some depreciation on your fixed assets, which is stuff that you have to capitalize, stuff like equipment, furniture, large purchases that usually more than about $2,500 is what is kind of the threshold we look at there. Think of like if your big machines, your furniture, that's going to cost that much. Your building, or not, your buildings won't qualify for bonus, but that's for fixed assets. Those are kind of the stuff that we think about. In the prior years, before we got this new legislation, bonus depreciation was decreasing each year. So if it wasn't for this legislation passed, you would only be able to depreciate about 40%, which means deduct about 40% of the cost of your new assets that you place in service each year. But they passed this law that's going to allow us now to go back to what we were doing before, which is take 100% depreciation, which means you can deduct 100% of the cost of some of your equipment and your furniture. Basically anything that's not a building. There's some outliers out there, but that's the easiest way for me to put it. Most likely you're going to be able to take 100% bonus depreciation if you want to on it. It's something you can elect out of in certain situations if you need to. Your CPA can do that for you, but it's really a big incentive for everybody to go out there and buy equipment, buy furniture, buy large purchases and that type of thing. So it's good to know that you can go out there and buy a $20,000 tractor or something like that, and instead of depreciating it and taking that deduction over 5 years, because of bonus depreciation, you can take that full expense in the first year. Another way to do it, so that's bonus depreciation. Section 179 is another code section that lets you advance some of that depreciation. We were starting to use it again a lot more recently when we had that bonus depreciation going down, like I had mentioned before. It's kind of the secondary option most of the time to bonus depreciation. You're usually not going to use this unless your stuff doesn't qualify for bonus, now that bonus is 100%. But it's something to keep out there. If there's something that doesn't qualify for it, there's some things like maybe your air conditioner, if you put in a big air conditioner on your building or something like that, where 179 might come into play. Just keep that in mind if there's something that your CPA can use to help advance depreciation. Business interest. The first thing I'll say on this slide is this rule does not apply for most small businesses. So unless your gross receipts average over the last 3 years $31 million or more, this rule is not going to apply to you. But there is a rule out there for large businesses over that gross receipts threshold that you can only deduct your business loan interest up to 30% of your business profit for the year. And so what they changed with this new bill, before you were calculating your profit, just kind of how it was, but now they're going to let you add back your depreciation and amortization again. That was a rule back maybe 3 or 4 years ago, and that's came back with this new one beautiful big bill. So something I wanted to mention, but I didn't want to spend a lot of time on because I don't know how many businesses in here making over $31 million in emergency. If you are, congratulations. You probably don't even care. Research and experimental expenditures. This is something that I see. Most people think, when they think of the R&D, they think of like tech companies making some sort of gadgets or software or something like that, and that is where a lot of that comes from, but it can also apply to companies that are creating products of some sort, and they're kind of doing some research into some new lines of products, research into how they can improve their product or something like that. There's a lot more cases where some of these research and development expenses can apply. There's a credit out there, by the way, that if you do that type of thing, if you are creating your own software, you have people that are doing research or helping you figure out ways to improve your product or your systems in your business, there's a credit out there. But for those people that were doing that credit the last 3 or 4 years, they were telling them any expenses that they had for research and development had to be capitalized, kind of like those fixed assets I mentioned before, meaning they couldn't expense those costs right away. They'd have to take those costs and they'd have to expense them over time. And this one big beautiful bill came in, and now they've changed that, and they've said that you can go ahead and expense those R&D costs immediately in most cases. They even went back and said for the past couple of years where you were having to capitalize it, if you were doing that, you can either go back and amend those returns to expense them, or in this next return, tax return that's coming up, you can take the expenses that you should have been able to and do it this year. And so if you have any sort of research and development that rings any bells for you, you should definitely talk to your CPA about it, because there is opportunities to take a lot more expenses that you miss out on otherwise if you weren't talking to them. Business meals. This is one that is usually interesting to everybody, and people sometimes have questions on. So there's something changing in 2026, and so it's kind of a big change for some companies, and some companies are like, I don't do that, so I don't care. But the big change is if you have meals that you're providing to employees at work, like either like in the break room, or you have like overtime meals or something like that, and you're providing meals to your employees, and it's not for like a big Christmas party or something like that, starting in 2026, those are no longer going to be deductible. And so meals with clients, that's going to remain where it's at right now. We think 50% of that is deductible. If you have holiday parties or big company events and meals are a part of that, that's still going to be 100% deductible. So really the big thing, I guess, to take from it is if you're having holiday parties and you're going to have meals and something like that, you need to break that out in your books or whatever you provide to your CPA to make sure that they know that these meals are for this party, so I can still deduct those. This is starting in 2026. Having a way in the way you keep your books, or however you provide your information to your CPA to break that out, because just regular meals that you're providing to your employees starting in 2026, just for normal days of work, are no longer going to be deductible. Does that make sense to everybody? Okay. So this is kind of a technical one, but I won't spend too much time on it. But in about 5 or 6 years ago, they came out with a limit for people on their individual income tax returns, where they could only take $10,000 worth of state taxes on their Schedule A for itemized deductions. So even if they paid $40,000 in state taxes for their business, so they were in California or something like that, and they were paying that much tax. Once it got down to their individual level, they were capped at how much they could expense at $10,000. Because of that, a lot of states came out with these pass-through entity tax kind of programs. The way that you file the return, so a way that you could file a return and pay the tax at the business level, and that you could take that expense for the tax, and you would actually pay the tax at the business level instead of paying it at the individual level. So say you're a partnership. In the past, if you had $100,000 of business income, that gets passed down to you individually, and usually that's where you pay your state tax. I know a lot of us estate tax as they can. They at least want to be able to deduct that expense. And so in the past, it would come down to your individual level, and then you could cap at how much you could actually expense at $10,000. But they came out with a way where you could take that full deduction, say you paid $40,000 in taxes, you could pay it on your partnership return and deduct it all on your partnership return before you came down to your individual level. Well, they were planning on it's kind of sounded like that was going to start to go away, but it didn't. So that still is out there. So that ability for partnerships and S corps to do that pass-through entity tax deduction is still there for now. Lynn might talk about this a little bit more when we get to the individual. I'm not sure if it's on her slides or not, but they actually came out with a new provision to where even if you're not using that, you can deduct now $40,000 worth of state and local taxes on your individual return, even if you're not doing this pass-through entity tax thing that I'm talking about. It is subject to some income limitations. I don't have those in front of me, but it's I think we're talking about 500 to 600,000 before they start to phase out. You have it there, so I'll let you talk about that. Excess business losses. So there are limits on using large losses in this state. So it's now made permanent after the BBB. And so what this is, if you have, if your business sustains like a large loss in a year, say maybe you bought a big building and you were able to depreciate $1 million of this $3 million building or something like that. Sometimes that happens. Sometimes people show a huge loss in their business even if things are going okay because they're able to depreciate this asset that they purchased. Sometimes when that happens and you pass through that loss, there's potential for it getting limited. If that loss is more than $313,000 if you're single, or $626,000 if you're married, you can get limited on that. Anything above that $626,000 loss, so you had a $726,000 loss, that extra $100,000 would be carried forward on your next return and treated kind of like a net operating loss, and you could use that to offset income in future years. And so that rule's still there, and now made permanent going forward. Has anyone ever heard of qualified opportunity zone investments? Is anyone interested in quality opportunity zone investments? Okay. Yeah, good question.
You're talking over here investments as buying options, actions, and stock. Is that what you're talking about?
It could be stock, but it could also be you could hold it personally. You could buy a property personally through it, or you could do it through a partnership or something like that. But yeah, it's more talking about real estate property, and so it's just something to keep in mind. If you ever have a large capital gain because maybe you sell your business or you sell a piece of real estate or stock or something out there, and there's a year where you're just going to have this big capital gain, you don't necessarily need all that cash right away, and you are willing to reinvest it in something. This is just something to maybe talk to your CPA about. It's called a qualified opportunity zone investment. You could basically take that capital gain that you have, instead of recognizing it and paying tax on it in that year, it's a way for you to defer it. You take that money that you got and you invest it in a property that is in one of these qualified opportunity zones, which are usually it's areas that the government has kind of marked based on statistics that are struggling economically, or they have some stuff and they need some kind of a boost to their economy in that area, and so they're trying to incentivize people on taking properties in those areas and investing in them and doing it long term. And so if you can find real estate property in those, there's a lot of companies out there that specialize in this. It's not hard to find one if you really are wanting to. You can take your money that you have from that gain, put it in here, and you can defer picking up tax on that gain for up to 5 years. And then you can, if you hold it for even longer than that, you can eventually not have to pay tax on some of that gain. If you hold it for over 10 years, there's potential that you won't have to pick up any tax on the gain. I'm not going to go into all the rules because we could spend 3 hours just on this thing. Just know it's something that's out there, something that you can ask your CPA about. heard it said, and so it's something we wanted to address and talk about. And starting in July of this year, you're going to be able to start contributing to these accounts. They're called Trump accounts. They're a new type of kind of like almost like an investment, like a retirement type account, where you can get some tax deferred savings. It's only going to be, for people under 18 years of age, but parents, family members, and employers can contribute to this, and you can contribute up to $5,000 per year per child. The money's going to grow tax deferred. The withdrawals, when you do take it out, are going to be taxed. All the earnings are going to be taxed when you take those out in the future. The idea is it's designed to help with education and business and life expenses in the future. It's not going to be like a 529 plan that you guys might have heard of, where it can only be used for education expenses. They will be able to take it out once they're over 18 and use it for different types of expenses. I think when we look at this overall, when you look at it, and like if your financial advisor's looking at it with you, the 529 plan, if you plan on your kid having to, going to college or doing some kindergarten through 12th grade, private school type thing, 529 plan has a little bit more tax benefit to it, because when you put money in there, when they take the money out, there's not going to be, when you take the money out, there's not going to be any tax due on that, even on that earnings, as long as you use it on education expenses. So that's a big advantage on the 529 plan. So this is going to be more for people that aren't wanting to use the money for education expenses, or for this next thing that I'm going to talk about, because children that are born from starting January, they were born after January 1st, 2025, all the way through the end of the year 2028, are going to be able to receive a $1,000 contribution from the government. That's just going to go into these Trump accounts. To be able to get that, you have to set up a Trump account for your kid if they're born for then, and you file, I think it's a form 4547 on your tax return, or you can file it as a separate form. You can put it with your tax return when you file it, or you just file it separately. Last time I checked, it wasn't ready yet to file, so if you're wanting to file your tax return this year right now, and you're also wanting to do this 4547, your options are either to wait to file your tax return, which I don't think you should. I think you should go ahead and file your tax return, and then you can go back later and file this 4547 once that form's actually available and ready to file.
So you're saying I can do this like for our nieces?
Probably for some family members. I'll have to look and see which all family members can do it, but I think so. You can at least talk to their parents and have them set it up for them. Someone just needs to file the form for them to get this account set up in their name. And once that account's set up in their name, all that system's going to go to all that information's going to go to government, and then they haven't announced when they're going to do a $1,000 contribution to have to eventually be able to put that money in there to start these accounts. There's also something out there for children that were born before 2025 that are under the age of 10. It's basically, I think, the family that owns the Dell computers has a foundation, like the Dell Foundation, and they put up enough money to where they're going to let people who have kids under the age of 10 that were born before 2025 in certain zip codes that have a median income of $150,000 or less, which around here, that's like almost everywhere. You have to go to some big cities before your median income is above that $150,000. Probably not a ton of areas where it's like that. We're talking real affluent areas if your median income is above $150K. But anyways, they can also go get $250. So even if they're born before 2025, as long as they're under age 10, before 2025, they're eligible for $250 to go into one of these accounts. And you'll just have to do the same thing. File that 4547 to set up an account for them. The other possibility where you might see people use it is if employers want to use it as kind of an incentive for their employees. because they're eligible to contribute up to $2,500 per year for the employee's children, and those contributions are usually tax-free to the employee.
Is that apply for self-employed?
Good question. I think so. I do believe so.
And it is deductible.
Yep, and it's deductible. So it's kind of like a starter investment account for kids, and it can grow over time. It doesn't have the specific usage limitations like the 529 plan does, but if you do think your kid's going to use a 529 plan, I would say also look into that. I mean, it doesn't hurt to get the $1,000. I mean, it's $3,000, so you might as well sign up for that if you can, and consider putting more in there if you can do this in addition to your regular IRA and things like that. You don't get a deduction for when you put the $5,000. So if you were just putting $5,000 in yourself, you weren't getting it from your employer, and we're not talking about that $1,000 that's getting contributed by the government. If you put in $5,000 a year, you're not going to get a deduction like you would in like a traditional IRA or anything for that. The earnings on that money will grow tax-free, and the earnings on that money will have to be taxed when you take it out. You defer it until you take it out. So it's just not as advantageous as some other accounts that are already out there. I think the real benefit of it is that you're going to get some free money from the government on it, and the possibility to get money from your employer money. Here goes the next slide. And this is a slide. It's just kind of talking about the way the account changes from when all the way up until the child is 18 till after they turn 18. Kind of talked about most of the stuff before they turn 18. There's no distributions allowed until they turn 18. That's something I should mention. So everything in there has to stay in there until they turn 18. There's specific investments. It's usually like these low fee kind of general equity funds that they have to use. So it's not as open as some other IRA types and what kind of investments that you have. They're going to have specific investment funds that you can use in these. They're usually kind of not the most risky ones, but just kind of general low fee investment funds. Then once they turn 18, they can start to take distributions. There are early withdrawal penalties if they start to take them before age 59 and a half. They can take out prior, like if people are putting in $5,000 a year themselves, that gives you basis. You can take that part out without having to pay tax on it. It's basically like an IRA account at that point. Any questions on the account? How it sounded at all? Yeah, it's interesting. There's you can see some good to it, especially when you're getting $1,000 in there, and there might be situations where you put some in there and let it grow for your kid, but there's just a lot of options out there, so we're just going to see kind of how it all plays out. It's also new.
One more question. Is it per kid or per employee?
Per kid, the 5,000. Yep. So no tax on tips. I'm sure you guys have all heard about this, and that's kind of how they advertise it. No tax on tips. Well, it's not exactly no tax on any tips that you get. It's really not even really that close to that. So it's really a temporary rule from 2025 to 2028 that lets certain workers deduct up to $25,000 of tip income on their personal tax returns. So this is for service industry employees who regularly receive tips. So the way they kind of describe it is if it's a job that normally receives it. They don't want people like, say me, going in there and starting to say, hey, I'll do your tax return for $100 and then you can give me the rest of it and call it a tip, but they don't want that to happen. And so they have kind of gone through and made a list of occupation types that are eligible for this, and if you go on the IRS website, you can find that list of occupation types that qualify for this tip. You have to work for an occupation like that, or be self-employed in an occupation like that to qualify for this tip credit. And so how it works is all those tips are still going to be reported as income. The reduction is going to reduce your taxable income afterwards on your personal tax return. It does phase out at higher income levels. So starting around $150,000 if you're single, or $300,000 if you're married, it starts to phase out the benefit of that credit that you get, and it's completely phased when you're married. So what employers need to do on this is you're going to continue reporting tips. Most of you, if you are working in a business that tips are customary, you probably already have some way of reporting those tips to your employees on W-2s or 1099s. You want to make sure those are tracked accurately. Starting in 2026, there's going to be a lot more specific way that you have to track those. There's going to be specific lines on the W-2s and 1099s and things that say cash tips, and they're going to ask for that occupation. There's going to be codes for these different occupations. They're going to ask for that, put it on there. But that's going to be on the 2026 1099s and W-2s and everything. 2025 is kind of like the Wild West. They said you can put it on there if you want to, but there wasn't specific rules on it. No one had to do anything because they didn't really give guidance in time for anybody to be able to do it. A lot of people, we still try to put information on there, but there wasn't specific lines to do it. We kind of had to add it as extra information on there. You go back to like I mentioned before, it's only going to be for a limited time. Right now, it's 2025 through 2028. And the big thing to realize is this isn't going to eliminate the payroll taxes. This is just an income tax deduction. So it's going to reduce your federal income tax, but you're still going to be paying the payroll taxes on that, so be sure it's on it. So your payroll taxes get deducted on your W-2. You already pay that in, and then on your federal income tax return, you're going to have a deduction, but it's not going to go back to get you that payroll tax portion. It's only going to help you refund some of the income tax portion. And no tax on overtime. It's kind of the same situation. It's not really just no tax on overtime. If you work, there's a certain amount that you could possibly get, and that is $12,500 if you're single, or $25,000 if you're married filing jointly. And the big thing that people don't know about this that I find a lot of times is this only applies to overtime that is considered overtime under like the FLSA rules, which is stuff that's time and a half. So like for me and Lynn, if we work overtime in our job, it is not time and a half. So that does not count for us. So we are salaried employees, and that just doesn't work like that in the work labor laws. So if the work labor laws work out to where you get time and a half, then that's that part of your salary. Just the time and a half part, not just that extra part is going to be subject to this tip credit part. So this does not mean overtime is completely tax free, but it can reduce the amount of income tax. Like the other one, it has phase outs based on your income levels. $150,000 to $300,000 range where it starts, and it's just you completely can't get it once your income's around $400,000 or $550,000. Go ahead. It's kind of like what I was talking about on the other one. 2026, there's going to be special reporting requirements on the W-2s and things for this, but for 2025, it was kind of like an optional thing to put it on there. I'm sure people will come back and ask you if you did, and if they were working overtime where they're getting paid time and a half, they're going to want to know how much of it, and they're going to end up asking you for it. So we've tried to put information on ours for that, but it wasn't required. But in 2026, when you start doing those information reporting forms, it will be. Yeah, we can go ahead and go to the next slide. Okay, family leave credit. I'm not going to spend too much time on this one. Just notice a credit out there if you are either paying wages for employees that are out on maternity or illness or long-term over 2 weeks of paid leave. And so the new thing about it is used to it was only for wages paid during that time. But now if you have insurance premiums that are paid for like a paid leave policy out there, those also qualify. So that's something I want to mention. But the more information is on there, you can look at if that's something that applies to you. Go ahead. Tip credit expansion. So this is something a little bit different. It sounds like what I talked about with the no tax on tips. But this is basically a credit for like hair salons, barbers, spas. Previously, it was only restaurants, bars, and food service businesses. Basically, if you're paying your employee minimum wage already, and then they're also getting tips on top of that, those tips aren't aren't really subject to employment taxes the way like tips for maybe like a lot of restaurants do it where they're not paying their employees full minimum wage and they make up a lot of that income with their tips. So all the way up unto minimum wage, those tips are subject to those self-employment taxes. But anything above that, they're not. You get a credit to kind of get some of those employment taxes back. And so the new thing this year is it used to be only for restaurants, bars, and food service businesses for the most part that could come back and reclaim that. But now they've added hair and nail salons, barbers, and spas, and some other personal care services. It's something that you just talk to your CPA. There's a form that you file on your business tax return or your personal tax return, depending on your structure, to reclaim that. Information reporting, real quick. 1099Ks, if you guys work through Stripe, Square, PayPal, for before 2024, you only got this form from them if you had over $20,000 sales and 200 plus transactions. But in 2024 and 2025, like way more people got these forms from Stripe and Venmo and all that, because there was anybody that had $5,000 or more of business go through there, no matter how many transactions. So some people got them even if they did one transaction that was $5,000 and they'd get a 1099K. But for 2020, 26, and forward, it's going back to the old rule where you have to have at least $20,000 and 200 plus transactions before you'll get a 1099K from them. And this is a good one. I think will help a lot of people. 1099 starting in 2026. Used to you had to issue to a 1099 to your vendor, to certain vendors if you pay them over $600 or more. They're upping that limit to $2,000, and it's going to increase with inflation going forward. I'll just tell you there's a new rule for certain farm sales. So if you have a farm or someone that has a farm and you sell your land, there's a new rule that lets you pick up that gain over time. I think it's over 4 installments. So that's something new. It's kind of lets you defer some of the picking up the tax on that over 4 years. All right. I would take questions, but I took up a lot of time, so I'll let them go.
I get the fun part. We can all relate to this part. Okay. So we're going to start with the tax brackets. This is the 2025 tax bracket. So, as you all know, we're progressive. We have a progressive tax system. So if you made over, as a single filer, you made over about $12,000, then the next dollar would be taxed at 12%. So, and it gets progressive. So you can see that it goes from 10, 12, and then a big jump to 22%.
So this is 2025?
That was 25, and then now we're going to go 26. This is the 26. So a little bit of an increase, about a 2.2% increase across the board, except for the 10 and the 12%, which increased about 3.9%. Just to try to keep up with lifestyle, the government is shifting the bracket just a little bit there. So I wanted to study last night, and I want to give you a fun fact. So fun fact, about 77% of U.S. tax filers are in the 10 to 12% range. And so in 2023, there was about 150 million tax returns filed. And of that 150 million, less than 1%, about less than 900,000 were filed at that 37% tax bracket. Just kind of fun fact. Okay. All right. This is the brackets for the capital gains rate for 2025. So if you sold stocks or assets that you held long term for a year and a day more, then depending on what your gains are, you can be taxed at the 15% or 20%. So that's really beneficial. You're not taxed at your ordinary tax bracket. You're taxed at the capital gains bracket. next one, and this is the 2026. Again, across the board, the IRS updated and adjusted by 2.2%. Standard deduction for 2025, 2026. I did the math for you. That's the change again. 2.2% increase over 2025. Okay, so we have a new provision, and it is temporary. It's going to be from 2025 to 2028. This is for seniors 65 years and older. So it's $6,000 per senior. So married, filing, joint, if both spouses are 65 and over, then it would be a $12,000 deduction. This is a below the line deduction. So the phase out starts at, and I didn't have it up here, but if you are married, filing, joint, then the phase out starts at $150, and for single, that it starts at $75,000. You're completely phased out for married, filing, joint at $250, and then for single, it's $175,000. And so essentially, this is really nice, because if you add, let's just say this the last section there. If you put your standard deduction, which 97% of the population takes the standard deduction, and if you're 65 and older, you get an additional $3,200 for your standard deduction. And then plus now the senior deduction, you can have a total deduction about $46,700 for married, filing, joint. Yeah. So this, and again, this applies for seniors. Okay. So this is an example of how that looks. I have a married, filing, joint, both spouses over 65. They have IRA, Social Security. He has a small W-2. So his taxable income is 84. He's not limited. He's not phased out. And so we have the standard deduction at $34,700, and then you see line 13B is at $12,000 senior deduction. So total deduction is $46,000. His taxable income's dropped down to $37,000. So he's like in 12% bracket now.
Something I'll just mention real quick about it is you might have heard, like, when this was coming through, like, there's no tax on Social Security benefits, and that's not really true. This is what that is really. This is how they did that. So this is, the senior deduction is supposed to kind of be giving you a deduction to cover that tax on your Social Security, but it's only going to apply for people that don't phase out based on their income. So it's not like any Social Security income anybody gets is not subject to tax, because I've had people ask me that and say, well, I shouldn't have any tax on this, but it's really just this deduction that they're getting.
At the same rate, your Social Security income is maximum is going to be taxed at 85% of its tax.
Yeah.
So still not completely gone, but okay. Okay, QBI. For QBI, this is my job security. QBI. So what is QBI? QBI is qualified business income from your pass-through entities or even a sole proprietor. It's a mechanism for business owners to get possibly a 20% tax deduction or a 20% deduction on that qualified business income. Okay, so they made it permanent now because it was supposed to sunset. It was supposed to go away. They made it permanent with one big beautiful bill. So it's, the QBI deduction remains at 20%. And you can see the phase out range. This phase out range is applicable to that 20%. And this is, the calculation gets more convoluted past this phase out range. Okay, but I wanted to mention this minimum deduction for this active QBI. So active meaning you have materially participated in that activity. Okay? So the minimum is, you'll still get a minimum of at least $400 qualified business deduction. If there was at least $1,000 was a phase-out range that reduced you down to zero, you would still get a minimum of $400. Okay. So this is that convolution that I was talking about.
We'll skip this.
We'll skip that. Okay.
Yeah.
But that was my job security. So child tax credit is made permanent with the One Big Beautiful Bill. It is a $2,200 per child index on inflation. $1,700 of that is refundable. And so I've listed what it is, the test that has to be met to be a qualifying child. So they have to be under 17 years old. They could be your son, daughter, stepchild, foster child, siblings, step-siblings, or any descendant of them. And they have to live with you for more than half a year. And then they didn't support themselves. They didn't provide more than half of their own support. And then they have to be claimed as your dependent. They're either a U.S. citizen, U.S. national, or U.S. resident alien, and a Social Security number is required. Okay, so, yeah, I guess we can go next. Go for it. Okay, this is the SALT limitations. So Greg had touched on this earlier. Previous to that, we had a $10,000 cap on your taxes. State and local taxes, property taxes, on your Schedule A itemized deduction. Starting for 2025, that cap is now gone up to $40,000. So, and then again, it's indexing. It's going to increase about 1% per year through 2029, and then drop back down to $10,000 for 2030. One thing I wanted to mention is that phase-out range that you see over there, the $500,000 to $600,000 for 2025. So what that is saying is, if for every, the cap gets reduced by 30% of the excess over the threshold. I got an easy one for you. Okay. So here's the example. Married filing joint, their income is, modified adjusted gross income is $510,000. So that's 10,000 over 500,000, right? Times that by 30%, that's $3,000 that they can't take. So if, say for instance, the deduction, their SALT was 20,000, then 3,000 of that 20 cannot be deducted. Okay? So, but it will never go below 10,000. That's charitable deduction. Okay, this one I like a lot. So if you're very charitable, but again, 97% of us take the standard deductions, we really don't get to utilize our charity giving. So this is saying that there's now it's not 1,000 of it if you're single, 2,000 if you're married filing joint will be just straight on the tax return. On 1040, it's not going to be through the itemized deduction. So that's really nice. But if you are one of the 3% that gets to itemize, there's a new 0.5% floor for your charitable giving. So let's say, and I got an example for this one too. Let's say that you had your AGI is 200,000, so 200,000 times this floor, that 0.5% floor, that's 1,000. So 12,000 minus 1,000 is your 11,000. That's what you get to deduct. So anything above your floor, you get to deduct. That's the 0.5% floor for charitable giving.
The reason why they come up with some of this like crazy stuff, like why are they doing that, is because the way they pass these bills, it's through a process where they have to budget everything, and so if they give you a deduction here, or to take away stuff here, and so a lot of the stuff you'll see, they'll give you this $1,000. I mean, I'm not sure if these are the two that are connected, but they give you some stuff and then they take it away, so they add this 0.5% for it, so then they can show, hey, we're taking away this much stuff. So that's why you see a lot of these
mention is that that first 1,000, 2,000, that's only for cash contributions. So if you gave stocks or whatnot, it doesn't apply to that. It applies to only cash contributions. Okay. We have a $750,000 loan cap. It's now made permanent. But the good thing is now also you can take your mortgage, your private mortgage premium, so your PMI. That's also available for you to have as a deduction. So people do HELOCs where they might take that loan to expand on their house or do some renovation. That is deductible. So that's all that's saying. Right? The debt has to be secured and used for that property. This one, okay. This one. So if you're in that 37% tax bracket, then your itemized deduction is reduced by 2%. So if, let's say you would have had a let's say you had a $40,000 total itemized deduction. Your tax benefit should have been 40,000 times 37%. But because you are in the 37%, they're saying now it's going to be capped at 35%. So you take your 40,000, you still get 40,000, but you're only benefiting by 35% versus your 37%. Does that make sense?
So you're talking over there about the people that does on the bracket the 37%. So that's the people that does between 640,000 to 768,000.
Yes.
Yeah.
That's the wealthy people.
Yes.
The less than 1% that files yearly.
The people probably not in watching this.
Probably. If they are, then
If they are, please come.
Yeah.
Okay. So you guys probably heard of this new loan on vehicles. So it is true. You get a $10,000, up to $10,000 of that interest is deductible. It has to be on a personal vehicle. It's not the vehicle is not used for business purposes. Okay. So there is a phase-out limit. Again, 150 for single, 250 for married, filing joint. You'll have to have a VIN number. You said personal use. You file it on the 1098. One thing to mention also is that it has to be a new vehicle assembled in the U.S. So it's not new to you, but it's brand new.
Like 0 miles.
I'm sorry.
0 miles. I'm asking because last year I got a vehicle that I use for my business, and this concerned me because if I got that vehicle, it's 36,000 per se, since you're talking about this. But I didn't get it under my business because I didn't know I should have get it under business, so it's personal. So when I do my taxes, it was like I think 12,000 miles. It's new to me, but I got it on the used car of the dealership.
Yes.
So
Yes.
that do not qualify.
It doesn't qualify.
Okay, that was my
You have to
question.
be the first, basically, one. Sometimes we'll go to the dealership.
Because that can be confusing.
Yeah,
Yes,
it can.
it
Because
is.
sometimes we go to the dealership and they'll have 1,000 miles on it. They've been doing test drives or doing something
Yes.
with it, but it's
Yes.
still new.
Yes.
That would qualify. But if someone's had it before and it's a used, then it won't.
Okay, thank you.
I have a question. So if you buy a new vehicle and you use it more than 50% for personal use, say you use it for 60% personal use and 40% business use, you still can't you use that? You can only use the 60%.
That would be my guess, but I would be guessing. I haven't looked at it, but that makes sense.
I mean, that's
you might know.
I had a client ask the same question.
Okay.
And the rule there is if you are trying to use it one for business use, it has to be used more than over 50%,
Okay.
right, for business use. So
I thought it was 50, more than 50%
pick a lane,
person.
yeah. No,
personal
pick a lane.
use.
If for business purposes, it has to be more than 50% business use to be able to have the business deduction. So you can always have, you can write
No, not the business deduction for the, I mean, you can use mileage, I guess,
Yes.
Right.
for the business. But I'm saying to even though you're using it in the business, but it's still personal use too, but it's over 50% in personal use. I didn't think it had to be 100% personal use.
It has to be for personal use.
Okay, because I didn't
Because
see that.
if it was for business purposes, then you could deduct the interest in
No, she's saying you can, you might have to go on a work trip. So you drive it up to Dallas and back again, and then you get those miles, back from your company, or you get the mile reimbursement. You can still claim this because it's still a personal vehicle. Doesn't matter that you got miles reimbursed.
Business.
I think we'll have to check in more
Okay.
on that, but
Yeah.
from what my research had showed me is that it has to be
Do they-
just personal.
Just
Okay.
a personal loan.
Yeah,
And there might be a
I didn't see
minimis.
that.
Yeah.
Okay.
There
Yeah.
may be a de minimis,
Mhm.
but from so far, from all of the guidance so far, there could be additional guidance that comes up. But from what we've seen so far, it has to be just a personal use. Greg touched on this a little bit, the 529 plan for your kids' college savings, and now not just for college, it is expanded to include all of these other expenses, so you can use the money funded in the 529 plan to cover all of this stuff. So so it now applies to public, private, and religious schools. This is so you can use it for your fees, education, therapies for students. So pretty much it has expanded what it covers, where before it was limited.
A few years ago, it was even only for college stuff, and so then they changed it to where you could use for private schools too. And so now they've expanded it even more to where it's not just the tuition and some of the things, you can use it for a lot of different expenses related to that.
Okay, this is the estate and gift tax exemption. So before the OBBB, this provision was supposed to sunset, and it was supposed to come back. The exemption was supposed to come back down to about 5 million, index for inflation about 6 million. But now they've made it permanent, and your lifetime exemption is 15 million, 30 million if you're young spouse. So, and the annual gifting right now that you don't have to file a gift tax return is 19,000. So you gift it to anyone, 19,000, you don't have to file a gift tax return. Oh, and it doesn't use your lifetime exemption. Any questions on that? Hey, this one's not really new. They're just wanting to reiterate some of the required minimum distribution. So prior minimum distribution, if you turn a certain age and you have a retirement account, you have to take out that money. Okay? So if you were born before 1951, you should have already taken RMD. If you were born between 51 and 59, then RMD starts at 73. And now, if you were born 1960 or later, then the RMD is at 75. So it's a way for you to leave money in your plan, let it continue to grow. That's really nice. But eventually, the IRS is going to want their tax on that earning and that money. This does not apply to Roth IRA. This is your traditional IRA. Okay. And 401k through your employer, you have your IRA, traditional or Roth, your HSA for self and for your family, and this is 26 limits. And then also the cash contributions. And then that's okay. In terms of your IRA, that one you can still, if you haven't yet, contribute up till April 15th of this year, and for your 25 contributions. And then now they have a super passive contribution, and that's to say that if you were in between